Thank you for joining us today on USAWatchdog.com. I'm Greg Hunter. With us once again, one of our favorite guys. He is a best-selling book author. You know him from Currency Wars. It was a huge bestseller. He's out with a new book called The Death of Money. And if you look, the tombstones are like pieces of money. The Death of Money. Of course, I'm talking about James Rickards. Jim Rickards, thank you for joining us today on USA Watchdog from your Connecticut home. I know you don't have a great signal, but you got great content to give us.
Thank you, Greg. Nice to be with you.
Well, I just want to, you kind of have a mini spoiler alert here on the front of your book. At the coming collapse of the international monetary system, you say it right on the book cover that you think a collapse is coming. And one of the things I got out of your book was whether we have inflation or whether we have deflation, what we're going to lose is confidence. Could you explain that for us?
Well, that's exactly right, Greg, and you're right. It's the death of money, the coming collapse of the international monetary system. And when I say that, when I talk about a collapse, it's really not meant to be a provocative statement. It's not just some, sort of scary sky is falling headline. The international monetary system actually has collapsed 3 times in the past 100 years. It collapsed in 1914, it collapsed in 1939, and it collapsed again in 1971. And when it happens, it doesn't mean the end of the world or we all go live in caves or eat canned goods. What it means is that you have a period of sort of economic confusion, and then the major powers, trading and financial powers, sit down around the table, as they did in Genoa, Italy in 1922, and Bretton Woods, New Hampshire in 1944, and the Smithsonian Institution in 1971. They sit around and they rewrite what are called the rules of the game. And when I say the rules of the game, that's not a phrase I made up. That phrase is actually over 100 years old itself. It describes the rules by which the major countries conduct international monetary affairs. So what I do for the reader is I first of all explain why the collapse is coming, and then secondly describe what this new system might look like. And that should be very helpful to investors in preparing both to survive the collapse and to be well positioned in terms of wealth preservation under the new system that's coming.
Well, in the last 2 systems, Bretton Woods and 71, the dollar came out good. Americans came out well. In this new system, what I'm gleaning from your book is that the dollar's not going to do very well. As a matter of fact, it's on its way to the trash bin in terms of world reserve currency. Can you explain what the world looks like in the new system here in America?
Sure. Well, under the Bretton Woods system, the dollar did very well for a while, certainly from 1944 to 1971. The dollar was anchored to gold at $35 an ounce. That system fell apart. It was sort of officially buried in 1971. But, the new system that replaced it did not emerge all at once. It came in stages. There was the Smithsonian agreement in 1971, but then there were other monetary conferences, the Jamaica Conference of the IMF, the Louvre Accord, the Plaza Accord in the 1980s. So it was really a transition. But what came out of that, thanks to Paul Volcker and Ronald Reagan in 1980 and 81, was what I call the king dollar or the strong dollar standard, and that lasted from 1980 to about 2010. Now, that was not a gold standard, and there was no hard and fast rule, but it was a standard where we said to the world, look, we're not backed by gold, but we will maintain the purchasing power of the dollar. You, our trading partners, and investors can have confidence in the value of the dollar. That was torn up in 2010. 2010 was the beginning of the currency wars. That was the subject of my last book. My new book, The Death of Money, looks forward and says, okay, where is this going? Now, when you say the dollar did well, it did do well under Bretton Woods. It didn't do so well in the aftermath. From 1977 to 1981, we had 50% inflation, 50. The dollar lost half its purchasing power in 5 years. That was borderline hyperinflation. Now, yes, Volcker and Reagan stabilized it in 1981 going forward, and it remained stable. But the dollar almost collapsed in 1978. The businessman went to Tokyo and checked into a fancy hotel. They didn't want dollars. They said, pay us in yen. We don't want your dollars. Same thing in Europe. Now, that was sort of the dollar was in a nosedive in 1978. It was pulled out of the nosedive by Volcker and Reagan and survived. But here we are again looking at another potential collapse. The problem today, of course, is that we are on a global dollar standard. That can work. I'm an advocate for gold, but I would say that a paper money standard can work. but only if you maintain confidence in the money, and you do that by modulating the money supply, running a good economy, having a good business environment, doing a lot of things actually that Germany is doing in Europe today. We're not doing that. We're doing the opposite. We're printing money. We have a lousy business environment. Taxes are too high. Growth is too low. So a lot of things combining to undermine confidence in the dollar. And then the point I make is that when the collapse comes, and we can talk about why the collapse is coming. There's a whole science behind that. That's not just something I sort of pulled out of thin air. I can explain that in a lot of detail. But the point is, when the collapse comes, the last time the system started to collapse in 2008, the Fed rescued it. How did they do that? Well, we know they printed over $3.5 trillion of new money in the last 5 years. The Fed's taken this balance sheet from $800 billion to over $4 trillion. People understand that. What's less well known is that the swap lines that they put in place with the European Central Bank. Now, European banks had dollar liabilities. They had borrowed money in dollars. The European Central Bank is their lender of last resort. Well, guess what? Pardon me. The European Central Bank can print euros, but they can't print dollars. So where did the ECB get the dollars they needed to bail out their own banks? They got them from the Fed. They swapped. They gave us euros, and we gave them dollars. So these dollar-euro swaps between the Fed and the ECB, which are not, we know about them, but they're non-transparent in terms of the size, that was in the tens of trillions. Then...
Tens of trillions of dollars we sent to Europe to float Europe, to bail Europe out. Wow, that's a huge number.
All the money market funds in the...
Yep.
Correct. That was we gave them dollars, they gave us euros. We still have the euros, by the way. The swaps have, by the way, the Fed's not transparent. We don't know the exact number. There's been enough disclosure in response to some requirements of Dodd-Frank that we do know it's in the tens of trillions. We don't know the exact amount. In addition to that, the Fed guaranteed every market fund in the United States. And they guaranteed, in conjunction with the FDIC, every bank deposit in the United States. So here you had a massive, order of magnitude, 60 to 100 trillion dollar bailout. Not the $4 trillion they printed, but all these tens of trillions of other guarantees, bailouts, swaps, and other things that were done. Now, fast forward to today, when the next collapse comes, it's going to be bigger than the last one. It's going to be exponentially bigger. In 2008, Greg, we all heard about too big to fail. Well, guess what? The 5 biggest banks in the United States that were too big to fail in 2008, today they're bigger. They own a larger percentage of the total banking assets. Their derivatives books are much, much bigger. And under my analysis, which I use complex theory and dynamic systems analysis, what that tells you, and it's very good science, is that when you double or triple the scale of the system, you don't double or triple the risk. You increase the risk by an exponent. It could be 10 times or 100 times. So here we've increased the size of the system. The dynamic is the risk is exponentially greater. The last crisis was barely enough for the Fed to contain. They've used up all their dry powder. They can't take the balance sheet any higher. They're already insolvent. I spoke to a member of the Federal Open Market Committee, a Fed governor, and in a private conversation over dinner, she admitted to me that the Fed was insolvent. It took a long conversation. At first she said no, and then she said maybe, then finally she said yes. But the point being, the Fed is insolvent. If you mark their assets to market, they're leveraged 80 to 1, and interest rates have been going up, so very small decline in the market value of their assets wipes out their capital. It's very simple math. So we have an insolvent central bank. They're at the outer limit of their balance sheet. The next crisis is going to be bigger. You can see it coming. It's going to be too big for the Fed. So how are you going to bail out the world the next time?
The next crisis is going to be too big for the Fed. That's a big statement. Too big for the Fed. Holy smokes. So how do we fix the next? I'm sorry.
Well, definitely be. Yeah, what are they going to do, Greg? They're taking their balance sheet to $4 trillion. What are they going to do? Go to $8 trillion? Leverage 200 to 1? I mean, the game is up. This has become very apparent. They are insolvent on a mark-to-market basis today, not like next year or the year after. They're insolvent today. By the way, they don't mark-to-market. They record all their assets at historic cost. So if they buy a 10-year note, for 100, and it goes down to 95, most of us, certainly in the hedge fund world, we would call that a loss. But they continue to carry that 100. If you mark-to-market, their capital would be wiped out. So they're already insolvent. And they're starting to recognize this. It's one of the reasons they're tapering. It's not because they think the economy is in good shape, but because they're worried about destroying their own balance sheet, which they already have. But my point is, same is true of the Bank of England, the Bank of Japan. The People's Bank of China has printed more money than the United States, more money than the Fed. So all the central banks are at the outer limit. So where is the liquidity going to come from the next time there's a crisis? The answer is there's only one clean balance sheet left in the world. That's the IMF. The IMF is only leveraged about 3 to 1. And in my book, The Death of Money, I have an entire chapter on the IMF, an entire chapter on gold, several chapters on the dynamic that we're talking about, other chapters on financial warfare. So we do really lay it all out for the reader. Now, most people know that the Fed can print dollars. The European Central Bank can print euros. The IMF has a printing press also. They print something called SDRs, or special drawing rights. It's a weird name. It doesn't sound like money, but it is money. It's fiat money that the IMF can print and hand out to the members. And it's not new. It's been around since 1969. They actually did this. I talked earlier about the period around 1978 when the dollar almost collapsed. Then the IMF printed a lot of SDRs then to bail out the system. But then they went from 1980 to 2009 with no SDRs. They didn't have to because that was the King Dollar period. But in 2009, they issued another over $100 billion equivalent of SDRs. The next time, I guess it'll be closer to the trillions because that's how much it'll take. Well, and that'll be the end of the dollar. Because China's a member of the IMF, so is Russia, so is Brazil, the BRICS, and the other G20. If we're going to bail out the world in SDRs, they're going to want more votes, more voice, and they're going to say, okay, we'll agree to bail out the world with SDRs, but that's the end of the dollar, because they don't like the dollar anyway. That's why they're buying gold.
And let's get down to gold, because you're, a couple of years ago you were saying that the price of gold, even if a partial backing would be 7,000 an ounce, now your number is 9,000 an ounce, and you say it might go lower and it might go higher, but I think you're in the camp that gold is going to go up in relative to dollar terms, and that's what I want to talk about. What does it look like in America when we get these SDRs and it's the end of the dollar? Do we have big inflation here? I mean, do we pay $10 a gallon for gas and, $14.50 for a loaf of bread? I mean, is that what we're facing?
That's exactly what happens. It happened in the 70s, At the beginning of in the late 1960s, gas was about, 19, 20 cents a gallon. By the end of the 1970s, it was $1.30 a gallon. So here you're looking at a 7 or 8 times increase. So today, sure, it's $4. But imagine gas at $20. Imagine, a loaf of bread at $10. That is what we're talking about. But the inflation will come at that point. We're describing not from dollar printing, but from SDR printing. But no one's going to understand it. I mean, talk about passing the buck. I mean, who elects the IMF? To whom are they accountable? They've got kings, dictators, communists on their executive committee. That's what the IMF is. It's the ultimate unaccountable national organization. No one understands it, which will suit the government fine, because they'll just blame the inflation on the IMF, and, good luck understanding that, because it's not very well understood. But the point is, when people say gold's going to go up, I think of gold as constant. I think of currencies fluctuating around the price of gold. So when somebody says the price of gold is up, I think that the dollar is down. If someone says gold is down, I think that the dollar is up. So I just hold gold constant and say, how many ounces of gold do you get for your dollar? And if gold goes from, say, $1,300 to $1,400, I say, well, a dollar used to buy 1/1300th of an ounce. Today it only buys 1/1400th of an ounce, so the dollar went down. So when I say the price of gold is going to go to 7,000 or 9,000, which I expect it will, what I'm really saying is that the dollar is going to collapse 80% or 90% or more, which it did in the 1970s. So none of this is unprecedented. It all happened before.
And I wanted to talk about your an interview like this. I could do 10 hours with you. I could do a series of 15 interviews, an hour apiece, to cover this book. Lots of stuff in this book, and I don't mean to oversimplify or gloss over it. Really good stuff. I took about 2 hours. I went over chapters, and I've got quotes, and my overarching feeling is that you think the collapse in the dollar happens sooner than later. There are some time windows of 10 years down the road, and they'll try to ease this in. But you're saying it ain't going to last that long. Is the Crimean situation something that could be a catalyst to collapse the dollars? Jim Sinclair, who I know you know, says, hey, Russia can just come out and say, we'll accept payment for our oil and natural gas in any currency. And he says that would kibosh the dollar faster than anything. What do you think about that?
Yeah, I don't think that's right. I think that the collapse of the dollar is coming. That's what the book is about. So yes. I agree with Jim Sinclair that that's just But the thing that destroys the system is the thing you don't see coming. And as we know about Crimea, we know, by the way, the financial sanctions that the United States is imposing are going to be very, very tame. They're not going to get a lot worse than they already are. They say, okay, so a few oligarchs can't go to the Super Bowl, big deal, or some oligarch goes to Geneva and his American Express card doesn't work. Who cares, right? This is the kind of thing we're talking about. But real sanctions, where you seize Russian assets, freeze Putin's personal assets, work with the Swiss, those kind of sanctions are not going to happen. Why? Because Russia can fight back. Unlike Libya or Syria or North Korea or Iran or the other countries who pushed around in financial warfare, Russia has its own arsenal of weapons. It's a lot like the Cold War, Greg, where we had missiles, they had missiles, we could destroy them, they could destroy us. What was key in that game theoretic context was what's called second strike capability. In other words, if we launched all our missiles at Russia, we would basically wipe out the country, but they would have enough missiles left to shoot back at us and wipe us out. Same thing in reverse. So nobody ever wanted to escalate tensions between the U.S. and Russia because it was we called it two scorpions in a bottle. You know, things that the victim's going to die, but has just enough strength left to sting back, and they both die. That was the balance of terror. Now that was called mutual assured destruction, or MAD, M-A-D. Today we're in the world of mutual assured financial destruction. The reason that President Obama will not put tough economic sanctions on Russia is they'll start to dump treasuries. They'll start to freeze our assets. They'll unleash their hackers and shut down the New York Stock Exchange. And don't think they can't do it. What do you think happened on August 22nd, 2013? Do you remember the NASDAQ was shut down half a day?
Yep.
Have we ever had an explanation for that? No.
Yep.
Was it Syrian hackers, Iranian hackers? I don't know for sure, but I know that exchange was shut down, and we've never had an explanation. That's just a cover-up. But make no mistake about the capacity of Russian hackers to do it. So that's the equivalent of firing nuclear missiles. Someone said to me the other day, "Oh, Jim, you know, if they shut down the New York Stock Exchange, we'll shut down the Moscow Stock Exchange." I was like, "Are you kidding me? That's chump change compared to the New York Stock Exchange." In other words, of course we have that ability. Our hackers are just as good as theirs. We could shut down it, but if they shut down the New York Stock Exchange and we shut down the Moscow Stock Exchange, who wins? They win, because our exchange is so much bigger. We have more to lose. So this is the balance of financial terror that's going on. As far as Crimea is concerned, it's not going to spin out of control for the reason I mentioned, but something will happen. It's you know, I always use the metaphor, but it's more than the metaphor because the science is the same, of the snowflake and the avalanche. You know, you had a large, complex system of snow on the side of a mountain, and it's unstable. So here comes a snowflake. It loosens a few flakes. They loosen a few more. It starts to slide. It starts to shoot. Then next thing you know, the whole thing breaks loose, buries the village, and kills a lot of people. Who do you blame? Do you blame the snowflake, or do you blame the unstable system? You have to look at the unstable system, because if it wasn't one snowflake, it would have been another. Or, put differently, if your system were not so large and unstable, the snowflake wouldn't have done anything. So, and you're right, people ask me all the time, "Jim, what's it going to be?" You know, as if somehow you could be happy in the stock market and then you would know what the catalyst was, and the night before you'd be so smart that you'd sell all your stocks and go buy some gold, and you'd be the one guy who had it all figured out. That's nonsense. When it happens, it'll happen quickly. You won't see it coming. There won't be time to get the gold. The gold may actually be unavailable at that stage. You know, you need to prepare now. Now, if you want some examples, I mean, it could be the failure of the COMEX, or the failure of a bullion bank to deliver, an assassination, a natural disaster, or it could be a lot of things. But the point is, it doesn't matter. It's the unstable system that matters.
And you think the system is so unstable, from here going forward, we could have that avalanche moment, we could have that blow up from here forward, just by any number of things, because it's so unstable.
Absolutely, because nothing was done in 2008. I mean, all the so-called bailouts, we never got rid of the bad debts. We never shrank the banks. We never broke up the banks. I mean, what you have to do to J.P. Morgan, you know, when I started in the banking business 35 years ago, J.P. Morgan was 5 banks, 5 big banks, by the way. It was the original J.P. Morgan, Chase Manhattan, Manufacturers Hanover, Chemical, and I think they got out of Wachovia along the way. These are huge banks, and now they're all in one bank. So break it up into 5 banks or 10 banks. And that doesn't mean that banks won't fail. It just means that when they fail, it won't matter. But if J.P. Morgan failed now, it would matter. It would basically wipe out the entire national monetary system. The government has to bail it out. But I've already explained how the government is at the end of its rope because they used up so much money in 2008. They don't have that much left. They don't have the capacity to do it again. So you're back to the hands of the IMF. Now, here's the thing, Greg. If people lose confidence in the dollar and the euro and the yen and the Swiss franc, are they suddenly going to have confidence in SDRs? It's just a different form of paper money. Maybe, the officials can obscure it a little bit. Maybe they'll use martial law. Maybe they'll resort to neo-fascism, executive orders, et cetera, to keep a lid on things. But it could spin out of control. That's where gold comes in. There's not a central bank in the world that wants a gold standard. I'm certain of that. But they may have to go to a gold standard to restore confidence. And if they do, it begs the question, what's the non-deflationary price? And that's how you get to the $9,000 per ounce.
And, one of the things I wrote all kinds of notes down. If you see my desk from this side, I got all these notes. And one of the things that I wrote down were your 5 investments. And at the top, you put gold. I even wrote somebody, said, hey, I'm in the stock market. What do you think? And I said, well, here's what James Rickards says are investments. You should be investing in gold, land, fine art, investing money in a hedge fund, and cash, of all things. We know why we should have gold, land, fine art. But what's up with cash? That's one of the things you kind of sheepishly said. I know it sounds kind of ridiculous. I'm talking about the death of the dollar, but I'm paraphrasing. But you should have cash. But cash is going to work really good for a short amount of time, isn't it?
That's right. And like people say, Jim, you're the guy talking about the collapse of currencies. Why would you have cash? And there are 2 reasons for it. Number one, we're right on the knife edge, Greg, of inflation or deflation. It could be either one. I mean, there are very powerful deflationary forces in the world. And the central banks and the IMF are right now, they're more concerned about deflation than they are about inflation. And the reason is they feel, I think they're mistaken, but they feel if you get some inflation, they can dial it down and keep it under control. But if you get deflation, they can't control that. I mean, they just think of what they've done since 2009. QE1, QE2, QE3, Operation Twist, currency wars, forward guns, nominal GDP targeting. They've done everything, and they still can't get the inflation they want. So deflation may be the bigger problem. In deflation, cash actually increases in value. So cash is, if gold is your inflation hedge, cash is your deflation hedge. I want to construct a portfolio that's robust in both states of the world, inflation and deflation, because you don't know what's coming. The other benefit of cash, even if you see inflation, it gives you optionality to pivot to another asset class. If you put all your money into hedge funds or other things right now that may be very good investments but less liquid, and then you say, gee, that was a mistake, I want to go over here instead, it's too late. You may be locked in. Whereas if you have cash, think of cash as an at-the-money call option on every asset class in the world. You can pivot. So I would say have cash for now. You might not have it for long. You might want to pivot into more gold, more art, or something else, but it gives you that optionality. As far as the hard asset portfolio is concerned, the point I would make there is, look at Warren Buffett. Everyone says, oh, Warren Buffett hates gold, loves the stock market. Really? Look at what he did a couple of years ago. He bought the Burlington Northern Santa Fe Railroad. He didn't just buy a stock position. He bought the entire railroad. He took it private. So now you could shut the New York Stock Exchange. It would have no bearing on his investment in the railroad because he owns the whole thing. He's like the German industrialists during the Weimar hyperinflation. They didn't care about hyperinflation because they own factories, right? So what is a railroad? It's all hard assets. It's land, rail, rolling stock, right-of-way, mining rights adjacent to the right-of-way, yards, switches, signals. It's all hard assets. How does the railroad make money? It moves other hard assets, corn, wheat, coal, steel, etc. So when I look at that transaction, most people, analysts say, oh, Warren Buffett loves transportation stocks. Nonsense. Warren Buffett dumped dollars and bought hard assets. That's what he did. So when it comes to billionaires, don't listen to what they say. Watch what they do. Maybe most of us can't afford to go out and buy a railroad, but we can sure buy some gold.
James Rickards, I tell you, in my humble prediction, because you don't need me giving for you predictions, but I think your currency wars was a big punch. This is going to be another one. It's going to be a big 1-2 punch, and I think you're going to have twin best-selling books. This is really a great book, The Death of Money. The Death of Money, and you're predicting this financial crash. I guess your only real problem is if the crash happens tomorrow, you got to get busy with the aftermath of the crash book, right? Well,
I'll publish about a third book. I'm working on this one right now, so I hope your viewers have a chance to get it, read it for themselves. And again, thank you very much for having me on. I appreciate it, Greg.
All right, James Rickards, again, The Death of Money, brand new book, just out. Go out and get it. Thank you, James Rickards, for joining us today on USAWatchdog.com.
Thanks, Greg.